Should be good to go. Okay, so today's session is gonna be about accumulations, right? Today is day 13, Monday, the 26th of January, and we will be covering distributions. Sorry, oh my god, accumulations. So we've been talking about distributions quite a bit, right? We've talked about them last week. I wanted to start off with distributions first, just because I wanted to tie in that one intro to shorting session into VPA, so it kind of made sense to flow from that into distributions. But it's not like one is more important than the other, right? In fact, I would suggest that most people first learn accumulations because they are usually easier to spot, and it's a lot easier to make money on the long side than the short side, right? We can all admit that. I'll be first to admit, even though I personally enjoy going short more, making money on the long side is still a lot easier, and you just feel like you have less kind of stress on your shoulders knowing that you're long instead of being short. Now, that doesn't mean go ahead and look to trade longs all the time, right? We know that the market does tend to go up over time, right? That's just a fact. No one can dispute that. However, that doesn't mean that longs should be traded all the time. The best time to usually trade longs, at least my favorite time, is usually after a market correction, right? After, doesn't have necessarily have to be a flash crash like the one we saw in April, but just generally speaking, after some sort of correction. And then after that correction, we get some sort of base, right? And then we get some sort of breakout, right? Out of the base, and then names start to move up. That is usually my favorite time to really be long and aggressively long, because you'll see that names have just reset, right? They've come off of some sort of correction period, and they've had their corrective phase, right? Where now they actually have room to move higher. So they'll set up some sort of base at the lows, right? After the correction. And then that could either be an accumulation base, right? Or it can also just be kind of a smaller base, which is also accumulation, but it's just not that big of a base where you can actually analyze it over a couple of weeks, right? It's more so just kind of a flash crash and a V recovery, right? Similar to kind of what we had in April. That was a bit more tricky to trade. The first leg up was definitely easy. I think everyone should have seen that from a mile away after we got that tariff pause and buying the pullback into that bar. That was probably the easiest trade all year. But as things started to break out into kind of we had the war fear, if you guys remember, things were kind of a bit harder to trade, right? Some names kind of looked a bit distributive as we moved back up to the distribution base from early in the year, and they were kind of harder to trade. However, they did still work, right? And names still continued to break out with a lot of different themes moving. However, the easiest longs are always going to be the first moves out of the base and the ones that really have some follow through and then set up and what I like to call mini bases, right? Which look like mini consolidation patterns that set up for higher as we just ride the trend all the way up to the highs. So usually when I'm looking to go long, right, I like to first spot a base. And that base is what I like to call accumulation, right? Accumulation is the opposite of is the opposite of distribution, right? So today's session is going to be all about accumulations, how to spot them, and how to trade them, and the difference between some good accumulative bases versus some that are bad. There's a quote that I heard a few weeks ago. I do not remember who it is. It is not my quote, but that there are no style points in trading. I might have said this already, I think, in the first week of this bootcamp, but always remember that there are no style points in trading. And what I mean by that is taking the harder trade doesn't result in a bigger P&L, right? You don't get bonus points or flare points or style points for doing something more difficult. 10% on a hard trade is the same 10% on an easy trade. There is no difference between the two. Your P&L is the same, right? So just something to think about whenever you have two setups right in front of you. One is very, very easily tradable, one that you can spot from a mile away, right? And the chart really screams at you, right? The chart that really screams at you is usually the one that you want to be trading. The one that you need to dig into it and really try to form a setup, that's usually the one that you want to avoid. And the charts that usually have screamed to me have been accumulations, right? Because those are very easy to spot. And especially when you have a multi-month accumulation that really sets up a massive base and then a name starts to break out. That is usually some of the best trades that I've personally taken, and certainly some of the easiest, because you just have so much room higher and names will just set up time and time again in a very, very clean manner. So the session outline, we're going to be breaking down what read accumulation looks like versus some textbook examples, how to time accumulations, right? Because that's another thing. If you guys remember when I was talking about timing and being in options when names are ready to go for that speedy move, it is very important in trading and understanding accumulation distributions in order to make sure that you are not getting chopped up, right? As I mentioned, with trading options, you can't just be buying when the underlying looks good, right? Or when you have a good read on a name. No, you need to be buying when you have a good read and when names look ready to actually have that momentum, whether it's to the upside or to the downside, right? So a big part of accumulations is not being too early, right? Because that's just going to lead to you getting chopped up, especially with options. With commons, it can obviously work, right? You buy some cheap name, right, at a very low price with a massive base that's setting up. And it's kind of easy to just buy and hold for weeks to months to 2 years. That is easy to do. But when it comes to options, no, you got to really be precise with your entry, and you can't just buy any accumulative base that you see, right? Because you don't end up just losing your premium to chop. Also, we talk about volume, right, and how to read that, and some common mislabels and some mistakes that traders make in an accumulation range. So first things first, what is accumulation? Accumulation is the preparation phase where supply is absorbed and price transitions from a markdown into a base before a potential markup. The best way to identify the best way to scan when you're trying to look for accumulative bases is by reading the market sentiment on some of those names. The names that are setting up in accumulations will usually be what is called dead money. You guys might hear that term being thrown around on Twitter or maybe some discords that you're in, right? Perfect example of those are Chinese stocks in 2024. When I posted a chart of Chinese stocks in 2024, the amount of hate that I got in the comments was insane, right? That is one example. Intel, before its run of 150% over the last couple of months, that is another one. When I was buying Intel, I used to get also a lot of hate. Why would you buy Intel when you can buy Nvidia? Why would you buy Intel when you could buy something like an AMD? Fast forward a few months later, INTC has moved 150% off the lows, while Nvidia is at the same spot that's been since July, right? And the reason for that is because Intel was in a very, very clear and clean accumulative base. Now, I didn't spot INTC to be an accumulation just because I thought that was dead money. No. But using that lens, right, and keeping an eye on what names are being hated on is a very, very great way to actually scan and look for accumulations, right? Or just to get some sort of general idea on what names to look out for, right? And then obviously the actual chart analysis will follow, right? Like that's the important part. So another example of that is also some growth names, including ARK. If you guys remember ARK, pre-election, so kind of late 2024, early 2024, I want to say. That was also considered dead money, right? While no one was buying those names. And a lot of them are actually setting up in very, very textbook accumulations. Earlier than that, there was also Carvana and Hood, Robinhood. Those are two that I remember trading very clearly. Unfortunately, I do not hold any comments on those. I was trading mainly options back then. I said I'm mainly trading options, but some of those names ran a 10x off the lows, which is pretty crazy to think about. I haven't been trading for that long. In case you guys don't know, I've been trading for 4 years, so I haven't really experienced names that have ran 10, 20x's off the lows as maybe some of you guys have over the past decade or however long you guys have been into the markets. But seeing a name like that really go, right, and I was able to spot it in real time, really did open an eye for me because if you are someone, right, who is not just into trading, right, you're more so into investing, which I'm sure all of us are. Personally, I don't invest as much as I should. I'm also just waiting for some sort of market correction to start doing that more. But using some of the tools that we teach in our swing trading strategies is a very very strong skill that you could use to actually buy into some of these investments essentially or long term buys. Obviously, I'm not a financial advisor. I'm never gonna tell you guys on any company that I think is gonna go to the moon because I don't know anything about that. But when you're able to spot some of these accumulative bases in real time, right, and it's on some sort of company that you like and you're planning on holding it for a while, you can usually get some really, really great entries on those and hopefully hold them for years, right? So always keep that in mind, right? Accumulations are a very, very big part of markets. It's not just about swing trading, but it can also go past that into long-term investments that you could look to buy in accumulative basis. So accumulations come after a markdown, right? After some sort of downtrend that the market or the individual stock has been in. And then we start to form a base, right? Starting with some sort of, usually there might be some sort of catalyst that initially stops the selling. And we kind of have like a sell climax from the markdown. It could be an earnings. From what I've seen, it tends to be earnings where a name is really downtrending hard into earnings, and then we get some sort of earnings report that gaps us down even harder, right? And you get some sort of climax look, and then the name bottoms and that dip gets bought, and then we start building out that base. Sometimes that doesn't happen. We don't need a catalyst to stop price from selling. The name might just get too cheap and people just start buying it up, right? Your edge is really going to come from spotting when selling pressure is weakening, right? And price is being more so accepted. Actually, hold on, guys, 1 second. I think I'm using the draft version. Sorry about that. Just give me a second here. My apologies, guys. 1 second. Okay. Sorry about that, guys. Just give me a sec here. Okay, we're back. let me just keep it like this. I'm not really familiar with this keynote. Okay, where were we? Yeah, so here. Um, 1 second, just making sure I got the. Oh my god. Okay, just wanted to make sure I got the recording also in check. Okay, so textbook versus real accumulation, right? And I just have this kind of as a, I guess you can say a caution slide, because one thing that I noticed is there's a lot of, like when you study a lot of the textbook moves, right? You tend to realize that names don't really move as textbook as possible, right? It's more so a bit different, or there's a few changes, right? And I think a good example of that is accumulations. A lot of textbook accumulation that you study, they seem so easy to read in hindsight, right? As if stocks actually move perfectly, right? Instead, they don't. And especially with accumulations, I've noticed that they're usually very messy, especially during the start of an accumulation, right? After a name begins to bottom. So a textbook one, right, what usually looks like perfect range boundaries, right? Obvious events, obvious entries, such a clean level of resistance and such a clean level of support. Volume kind of needs fadely into the base, right? Easy to label in hindsight. Real one usually starts with a lot of chop, a lot of fake breakdowns, and multiple tests, so multiple pullbacks into those breakdowns, right? Price consolidates randomly at first with multiple attempts higher. That is key, right? Usually accumulation bases, at least the most powerful ones, are going to take a long time to form, right? We know that the larger the base, the larger the move that comes. So when you have a multi-year base, right, you really want to be paying attention to that, because that can lead to a massive breakout. If it's a small base, then usually the breakout that'll follow will also be smaller, right? That's just something that you could always keep in the back of your mind. It doesn't always have to hold true, but generally speaking. And then price finally begins to consolidate near the highs, and then we look to go for the breakout, which is where we want to be really aggressive. So real accumulation looks something similar to this, right? Initially, it starts with a downtrend, as we mentioned, can be coming off of a massive distribution and then a markdown phase, and then the markdown begins to slow, right? So sellers are not really making lower lows as aggressively. It's kind of taking them a while to make a new low, right? And then that new low kind of starts to get bid up. You also notice that the candles are starting to get slightly smaller, right? Showing that expansion of the downside is slowing down. And you start to get repeated tests of support, right? That fail to continue lower, like I said. So we'll make a new low, but that low wouldn't really hold. You'll start to see buyers step in and bid things up. A good example of that is JD. That was a trade I think I had in this Discord. It was a few months back, but that was a very clean example where price really took a long time to make new lows, and every time a new low was made, that low would get bought up, right? You start to see these lower wicks come in, and some stronger action off the lows with increases in volume, which is key, right? And then as we progress more and more into the accumulation, rallies start to feel a bit more easier. You start to see a bit more follow through, right? Pops are not really getting sold that easily. Price is reclaiming the moving averages and starting to show some signs of strength and building higher highs and higher lows within the base still, right? Supply is not showing up as much on a pullback, right? Whenever we do start to see some selling, the volume isn't really there. Again, key part of identifying accumulations as well as distributions, of course, is the volume and looking for off the lows in accumulation, right? And then low volume on the pullbacks. High lows begin to form, right? And every low, as I said, is getting some sort of bid. The key idea is accumulation is less about a pattern, right? There is no necessarily, it's not really about a pattern that you're looking to trade. It's more so about supply starting to decrease and demand starting to pick up as we build out inside a range and we get closer and closer to the breakout. And once we break out of an accumulation, we enter what is called a stage 2. As we mentioned in the market cycles, session, right? So we kind of tie those two together. And accumulation is also a stage one. It is basically the same thing. It's just, I like to name it, I like to think about it more of from an accumulation perspective, right? Because an accumulation really does paint a story. It paints a picture, right? There's a story that's being told that a name is being accumulated by said institutions as it gets cheap, right? A stage one is more so just the technicals, right? You can't really explain what stage one is. It's just stage one means base breakout, right? That's just the way that I like to think about it. So I'm focused on spotting accumulations. So half the time accumulations, or kind of the three different phases that I like to call or I like to look out for in accumulations. Now, some of you guys might be familiar with Wyckoff and the really kind of nitty gritty parts of Wyckoff. I don't consider myself a Wyckoff trader. You guys know, if someone in here does follow Wyckoff closely or has read his books, then you would know that Wyckoff has a lot of different phases, right? It's like phase A, phase B, phase C, phase D, and all the way into phase E, with a lot of kind of details to each phase and what to look out for. I've studied those, and I've read his one of the books by, I think the author's name is Ruben Chavez, I think it is. It kind of has a dark cover. Great book, by the way. Absolutely amazing book. But what I took from that is just how to actually spot accumulations and distributions. I don't like to dive deep into the nitty gritty of Wyckoff. Instead, I just kind of formulated my own meaning and my own keys that I look out for within the different, within accumulation, within a distribution. So the three kind of stages that I like to look out for in accumulations is it's the early, the mid, and then the breakout, right? I'll keep it simple. The early part is when the downtrend comes to an end, right? We have the massive downtrend, price begins to stall, right? Lower lows aren't really having any progress. Sellers are starting to kind of weaken, and supply is being really absorbed by buyers. You start to see some sort of buyers stepping up, right? And you usually see this is usually when the worst news comes out for a name, right? Like whatever sort of headline, right, or could be a catalyst, as I mentioned, some really bad earnings report that comes in at the lows. That's another example, right, where names really get extended to the lows and it eventually starts to stall out. And then you have the mid phase, right, which is usually when the accumulation is actually being built. And this is usually the longest phase. So the early part and the breakout part don't usually last that long, but it's the mid that actually does take a while. So you want to be cautious of that, and you want to make sure that you are not getting aggressive during the time where an accumulation is actually being quote unquote built. That's when the range is developing. And as I mentioned, as options traders, again, guys, I like to repeat a lot of things just so I can really get it stuck. As options traders, you want to be able to time speed. You don't just want to be able to time the directional move. Buying options when a name is just chopping in a range in an accumulation can be a very bad trade because you can get chopped up very easily. So this is when the range is really developing and lows are being absorbed and you're starting to see some sort of failed breakdowns. However, you're still not seeing any true sign of momentum that is building to the upside, right? You might see an attempt or two attempts during this phase, sometimes even three, but usually those attempts end up failing. They might get some sort of one day breakout and then you'll see that price ends up failing and moving back down into the range. That is okay, right? I know I said in one of the sessions earlier about when looking to trade momentum, you don't want to see a lot of attempts for the continuation that fail. This is different, right? So make sure you differentiate the two. This is more so about waiting for the accumulation to actually finalize. The momentum, right, and looking for attempts out of momentum for continuation uptrends, that's different because if you're starting to see a lot of momentum attempts fail within the same setup that you're looking at, then that means that that momentum pattern or that momentum setup could be used to finalize an uptrend, and institutions could look to start basing this out for a distribution. Make sure you're differentiating the both. Did I make sense there? There might have been a bit of a kind of brain or tongue twister or something. Does that make sense? Okay, perfect. So make sure you're differentiating the two. And then we get to the fun part, which is the breakout, right? When prices are actually emerging out of the base. This is when you really start to see higher lows form, right? Clear higher lows every time we make a new high and then we start to pull back. Buyers are stepping up more aggressively at higher prices. By this time, we're usually above the daily moving averages, right? And we're starting to see a lot of demand. And then the most fun part is the last pullback at range highs. That is usually the best opportunity within an accumulation. And that's the one that can really set you up for a massive, massive, massive win. There can be some sort of catalyst that take us out of a base. Sometimes it could be some sort of earnings, just like the hood base that I traded. That was earnings that really gapped us up and above. Other times it could just be kind of a theme that's moving. Sometimes it could just be price, right? So don't try to like overthink it. Just make sure you are following price first, and then if there is some sort of catalyst, then you could potentially look for that catalyst to be the ignition out of the base, right? That doesn't mean go long into that catalyst. Big mistake. Never do that. All right, you'll never see me holding options into an earnings event. That is just no, big no in my book. Never. All right, never, 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 never. Instead, wait for the catalyst to occur. 9 out of 10 times, you're gonna get some sort of IV crush, and you'll be able to pick up some cheaper contracts. If we gap up, you'll find a pullback over the next couple of days that you'll be able to buy. If we open flat, then the premiums are just really cheap and you can buy them up. If we gap down, then just wait. The name might still be continuing to build out the range. No, I actually trimmed out a zone. I closed my position. I had my last bit was the April contracts, and they were super out the money. Funny enough, they're probably the most out of the money contracts I've ever traded. I bought the 150 calls when price was I think about on like 118 maybe. So I couldn't hold them for any longer. The premiums really got juiced, and they ran up like 200% on one day. So I had to just take them off. I mean, if they're runners, why not? But I'm talking more so about an actual position. I'd never swing through earnings. But runners, yeah, I don't mind swinging a runner or two through earnings. Yeah, no issues there. Risk free, paid for. Yeah, by all means, I'd do that. But yeah, so a breakout emerging, right? This is the part where we really want to be aggressive and look to capitalize on some full sized positions. So volume behavior inside the range usually looks something similar to this. Volume initially is high, right? And the reason for that is because of the sell climax that appears, right? For a name to exit out of a stage 4, right, and put an end to a downtrend, you want to see an increase in volume. Guys, always keep in mind, right? Whenever you're looking for a name to potentially do something, whether it's to end a downtrend, whether it's to start an uptrend, whether it's to exit out of a base, whether it's to have some sort of parabolic top or have some sort of parabolic long off of the lows, you always want to see volume extremely high. It doesn't necessarily have to be extremely high, but you definitely want to see a big increase in volume, right? That just always keep that in mind, right? And that should be a very important aspect to basically all your setups, and especially when really looking at price structure and trying to understand what's going on, right? Always look for that high volume to really start the thing that you're looking for, whether it's to end the downtrend, right, and start building a base, whether it's to exit out of a base and enter into an uptrend, whether it's to end an uptrend, or whether it's to exit out of a distribution and start a downtrend. Always look for the pop and volume. And you don't have to be in before that pop in volume, right? Don't think that. No, you can come after. Let the first shorts get squeezed. Let the first longs get shaken out, right? You come and buy the stops after you see that volume pop in. I want to say maybe four out of five times, you're gonna see some sort of pullback that you can buy. If you're going long, and if you're going short, you're gonna see a pop that you can short. So always just keep that in mind, that whenever you see that high volume, that's usually your sign that, okay, this could be setting up. And if you don't see that high volume and things are just really, really slow, then it's best to usually avoid and wait for that high volume to come in, right? This also ties in with volatility and understanding how volatility actually kind of works. I don't want to get too deep into it because I have a session to cover that. But essentially, whenever you see that high volume, usually there has been a ton of volatility on that day. And what can usually happen is price will have some sort of a decrease in volatility over the next couple of days that you could look to buy, right? Where options cool off, premiums decrease, and you have a much better risk to reward on those same contracts. Doesn't always have to happen. Sometimes you'll get that increase in volume and names just go absolutely crazy the next couple of days. That can happen, right? Don't get me wrong. However, more often than not, you will see some sort of pullback to buy or some sort of pop to short. So just keep that in mind. Yeah, so this is what volume essentially you want to look for inside of a range, right? You want to see that at first, very high volume, right? Which will usually stop the downtrend or at least begin to stall it. And then throughout the mid-range, you start to see volume really decrease, right? With no participants really participating, right? Things are just kind of stalling out and building out the range. And then you start to see volume pick up again as we begin to break out. And that is when you want to be really aggressive and look to push things. So some of the two key events to look out for: the shakeout, right? Just how in distributions we have failed breakouts. In accumulations, we have shakeouts or failed breakdowns. They're basically the same thing. Right, distributions and accumulations, you can think of them very, very similarly, just on the flip side, right? So a failed breakout, failed breakdown. So you really want to see a failed breakdown and some sort of shakeout. That gives the setup a lot more juice as it shakes out the weak hands and lures in some late shorts that get trapped, and then they're forced to cover as the name breaks out of an accumulation, and that just adds a lot of fuel to the breakout. That is one key event that you really want to watch out for. And the other one, which is the one that is the most important, is when momentum sets up at the highs, right? Which is what you have here. With momentum, price setting up near resistance. I personally like it when price consolidates right under resistance, and then I look to take the breakout through that instead of waiting for resistance to be flipped as support. But at the end of the day, it's really preference and what you like to see. But essentially, all traders should be looking at the same thing, which is a push up into that resistance zone, consolidation on low volume, and then we look to trade that breakout out of the accumulative base. That is when you really want to be focused on being aggressive with options and going long calls. Usually if I see a setup like that, I'll also be grabbing some leverage. And again, leverage in my books doesn't mean I'm getting on margin. No, leverage just for me means shorter dated contracts, as in weeklies that I'll look to get aggressive on. I don't trade weeklies often. I allow myself usually one trade a week. That is in weeklies. I don't like to take any more than that, so I make sure that I'm saving it for the best opportunities. But sometimes there's weeks where I don't even trade any weeklies. But when you see something like that is consolidating and setting up for a big momentum and breakout move out of the accumulative base, that's usually when you want to be pressing it on size and being aggressive. You can also build out multiple different positions, as in you can have something that I really love to do, especially on an accumulative basis, because I think I mentioned this. I don't get off topic, but I don't like shorting via comments. I'll always short via long puts. So the time where I get to really be aggressive on comments is an accumulative basis. So at this time, what I like to do is I like to build out 3 different positions. A core position in comments, right? And the comments you can start earlier in the base, or you could potentially start it on the shakeout, or potentially early even in the sell climax, because they're commons, right? Time is not against you. You can hold them. And then you get really aggressive on them as you set up for the breakout. But that could be a core position. And then I look to take a position on contracts that expire in about, usually the time frame that I like to use is around 60 days. I don't like going past that personally. But if you do, then go ahead and do that. And then I'll also take the leverage position. And obviously my sizing will be biggest in the commons and then in the 60-day sell expiration options. And then the last, which is the weeklies, which is the one that I'm looking to catch a 5 to 10x on. Doesn't have to go all the way to 10x, but I'm not looking to trim it for like a 50% win. I think that's stupid in my opinion. Weeklies and shorter dated contracts should be used as vehicles to catch some really, really massive wins, but also sizing smaller, right? At the end of the day, $100 lost on a 10% loss on a $1,000 position, it's the same $100 that is lost on a 20% sell on a $500 position, right? It's the same thing. And at the end of the day, it's just about keeping your risk the same across the different positions and making sure that you're not risking more than what you're willing to lose. But yeah, so that's how I kind of like to go about it. And I'll use the weeklies to really juice that initial breakout and then trim those and then hold on to my comments for as long as I can. And then my 60 days at expiration, I'll begin to trim them as we kind of start to get extended out of the base and start to see that 3 to 10 day breakout. That's the way that I like to go about it. You guys can have your own preferences. But personally, that's the one that I've seen the most success in when trading accumulation bases. And I always try to make sure that I do attempt some commons because those commons, like I said, they can run a lot. Perfect examples of that: Hood, Robinhood, and Carvana. I've seen those two run a 10x right live in front of my eyes. Called the accumulative base as clean as day, right? Anyone could have seen it from a mile away. And fast forward 2 years later, they're both up a 10x. I think I'm not sure the exact amount. But if you guys just open their charts and go to the base, go back to 2023, you'll see the accumulation playing out in real time. So some common mislabels and mistakes that some traders make. Number one, calling every sideways range an accumulation. Right? That's a big mistake. Not just because price is basing after a downtrend, it means it's an accumulation. Sometimes price could be basing because it is setting up for a leg lower. A good example of that in today's market is some quantum names, more specifically QBTS. If you guys read the Substack post, I posted a short idea last week and the week before that. And so far the underlying is down, I think 20% from there. Unfortunately, I do not have a position because I was focused on Nvidia and silver, but that was a very, very clean move. And that is one that set up what some people might think is some sort of accumulation because it just came off of a downtrend, but instead it set up something that looks more like a redistribution, and it is now entering some sort of markdown again. And one of the biggest reasons why I was able to spot that and understand that this is not an accumulation is because there was no volume. Right? Volume is probably the most important part of my trading. I did not see the big volume off the lows. I did not see volume that came in and tried to stop the downtrend. I didn't see any of that. Instead, it was just a low volume sideways move, right? That was just consolidation after a big sell-off and then setting up for another leg lower. So keep in mind, not every sideways range or every base is going to be an accumulation. You need to use context. You need to understand also the market cycle that we are in, right? It's more difficult for a name to enter an accumulation base when the stock market is, not the stock market, but the QQQ is setting up a base at all-time highs that looks more like distribution, especially when it's a tech name, right? So that's why it's important to always have some sort of correlation in between the index and the individual name that you're tracking. Doesn't mean names can't be an accumulation. There are some that are an accumulation, but it's just very difficult for you to find a tech name that is in accumulation when the stock market has just ripped for 9 weeks. So it's like if a name hasn't broken out while QQQ was ripping for 9 weeks straight, what has it been doing? Right? Like it just doesn't make sense. However, there could be a lot of other names, right, that don't deal with tech that are in very clean accumulation basis, just like energy. Those were super clean. Exxon, I don't really think that Exxon was more so an accumulation. That was more so, in my opinion, a rotation trade, which are a bit different. It's kind of, there's kind of similar. They have some similarities. You can call that an accumulation as well, though. Another very, very clean one was XLV. If you guys remember my call from, I think it was probably like 2 months ago by now, that was setting up in a very, very clean accumulation that is super, super textbook and worked out very nicely. But yeah, so always make sure that you're looking at the context of the chart and not just thinking that, okay, base means accumulation. No, don't do that. Another mistake is that I see a lot of traders that aren't really familiar with Wyckoff starting to label everything and starting to really just, if you guys see those famous pictures, those Wyckoff pictures that are all over the internet, where it kind of has the different phases. I see a lot of people just try to like mark those on any range that they see. Don't do that. If you want to do that, just make sure you read the book first so that you actually understand the different phases and then go ahead and do that. But don't just find some sort of image of what a chart should look like and just start painting it onto yours. Don't do that. Ignoring time. Real bases often take longer than you want, and the big base is always more preferred, as I mentioned, so keep that in mind. Mistaking distribution for accumulation after an uptrend. We talked about that. And another one is treating one failed breakdown as a green light to go ahead and start buying options. I don't like doing that. I don't like buying calls on a failed breakdown, because in a failed breakdown, even though a name can bounce, that doesn't necessarily mean that momentum and speed is there, right? Remember that. So personally, I like to avoid that trade attempt of a failed breakdown. To me, it's different than a failed breakout. Failed breakouts can usually result in very, very fast moves to the downside, but failed breakdowns, usually from what I've seen, not as fast. We'll be diving into those next week, or maybe I think it might be in one of this week's sessions. But notice how I keep talking about speed. That is very, very important. I want you guys to always remember that. And then the last mistake that I also see pretty often is overtrading the middle of the range. The worst RR, especially for options. And the reason for that is because if you buy calls during the sell climax, you can actually get lucky and catch some sort of very, very strong bounce as the name gets really extended to the downside, right? Think kind of similarly to a mean reversion, right? So that's in the early stage of the accumulation. In the late stage, you're obviously going to buy the breakout, which is obviously going to be the best trade idea. But in the middle, you're getting none. You're not getting a mean reversion to the upside. You're not getting a breakout either. Instead, you're just getting chop. So usually the worst are and one that you want to avoid. Some checkers that you can use. Number one, prior trend was down, right? Or at least weakening some sort of downtrend. Range has clear boundaries. Support and resistance doesn't have to be exact to the level, but some sort of zone that is respected as support and some sort of zone that is respected as resistance. Breakdowns fail quickly, right? You're not seeing that downside follow through anymore. New lows are getting bid up. You're starting to see a lot of lower wicks. You're starting to see a lot of action and a lot of volume coming off the lows. Rallies begin to improve, right? You're seeing more progress, fewer wicks to the upside. It's more so price action making higher highs and higher lows, right? And it's starting to reclaim a lot of its moving averages and start to flip them as support. Volume contracts in the middle of the range, right? As I mentioned in that image that I showed you of what volume should look like in an accumulation. You want to see that. Higher lows begin to appear, right? As I mentioned, buyers are excited to buy this name at a higher price, right? That's what a higher low is. Breakout starts to leave the range, or basically what a breakout is, and expand and get some sort of expansion out of that. Pullbacks hold before continuation. So when you do get a pullback, it's slow and controlled, and it's one that you can kind of get behind, right? It's not a strong sell-off the highs with a lot of supply that's pouring in. Some simple execution framework to think about, right? The best trade is always going to be the breakout of momentum near the base highs. I look to enter on some sort of contraction pattern, right? Or some sort of pullback, or just a continuation pattern, right? Keep it simple, but make sure that you have the context behind it to back it. risk, right? Always define your invalidation first and avoid the middle of the range. I would say avoid the early range as well. It's difficult to trade a mean reversion to the upside. It can be profitable, but mean reversions should be avoided. They are not good trades, guys. I used to be a very, very big advocate for mean reversions, and I still do trade them to today. However, they just waste so much mental capital that I would much rather just save my mental capital for setups that are like the breakout of an accumulative base or some sort of failed breakout or price entering to a stage 4 from stage 3. All those trades that actually have a lot of momentum behind them. Mean reversions don't really have that momentum factor and that speed factor. Sometimes they do, but it just takes up a lot of your mental capital. But regardless, it's still a setup that is in my playbook. It's just I'm starting to be a lot more picky with the ones I trade. So try to avoid the early range, and instead just wait for the late range when the price is actually ready to break out. The best accumulation trades feel very boring, right? Structure is clear, your risk is controlled, and continuation is earned by the stock actually fueling up for quite some time. And again, always remember the best accumulations are going to be names that have the worst sentiment and are hated by everyone. Keep that in mind. Final takeaway, accumulation is a phase, not a label. It's not a setup, right? It's not just the accumulation means buy. No, accumulation is something that you want to use as context and start to understand what price is actually doing before waiting for some sort of pattern or some sort of momentum trade to set up at the base highs, right? Trade when behavior improves, right? Less downside follow through, strong pushes, and very clean risk levels. Trade the structure first, right? Smart money is optional, price is not. Always remember, right? You want to make sure that the structure is there. You're not just buying any base that you see, right? Not just you see sideways action means accumulation buy. No, you want to actually understand the structure and the context and use that to your advantage. That sums up the presentation. You guys have any questions? Yeah, I can go over some examples. But guys, by the way, most of the sessions have been on slideshows because the trading view deep dive sessions are going to be during the last week. That's going to be the week where I show you guys my personal charts that I've broken down with a lot of labels. So I'm trying to save them for then. But yeah, I can show you guys some quick examples. Let me just switch over to trading view. God, I hate when this thing lags. 1 second. Yeah, Leafs would be a good vehicle to buy in accumulations, definitely. Personally, I don't trade Leafs. I just much rather be more aggressive on um, shorter dated and then looking to roll the shorter dated whenever they are setting up. But that's also because I'm on the screens every day, so it's easier for me to do. If someone doesn't have the as much time to be on the screens all day long, then Leafs would be a better option. But me personally, I don't have experience trading Leafs. Yeah, you can look at accumulation on any time frame, right? At the end of the day, guys, accumulations or distributions can happen on any time frames. However, we want to be paying attention to the daily. I don't know why my trading view is not showing up on my Streamlabs. You guys have any idea how to fix this? Yeah, I know you guys can see on Discord, but on Streamlabs where I'm recording, I can't switch over. It's just stuck on the presentation. Okay, never mind. I found it. I fixed it. Okay. Um. Okay, what do you guys wanna? 10. Let's take a look at 10. Is 10 in an accumulation? Well, first things first. Step one of identifying an accumulation is you want to see that initial downtrend, right? That just makes it a lot easier to read. This one could potentially be an accumulation, right? But I personally don't like trading IPO bases that much because there's just not that much data to study, right? But I mean, yeah, it can break out. Sure, this could be an accumulation. Personally, I just don't know. To me, it's just too early to trade it. You could potentially look to trade something here, maybe, but I just rather kind of wait. Hold on, let me just try fixing something. But yeah, so ideally I want to see more data that I could look back at and study. That's all. But yes, probably my favorite examples to actually look at accumulations. Yeah, Baba, and I like talking. You guys know this by now. I like talking about charts that I've traded. I just feel like it adds a lot more to it, right? Because I've had real experience trading this exact name and this exact setup, and Baba is a very very good example of that. Unfortunately, I was a bit too early on my first attempt. That was from back here in Feb, I think. Was it? No, it was November. But yeah, this is super super textbook. So we got Baba, we got Hood. This is what I was talking about. This base from back here. I bought this. I think this might be my drawing even from back then. That's what I logged. Looking back at it today, I don't know if I would have bought it up here. This was definitely an extended entry, but led to a massive, massive breakout that went all the way. My goodness, it's just insane to look at. A 10x, and that's from the breakout of the accumulation from the low almost to 20x. Carvana is even crazier. This is at 400 from, oh my god, I always forget how big this was. That's a 70x. This was the base that I traded. There's a sell climax. Right, there's this kind of some sort of failed breakdown, and then you start to see volume starting to pick up. Continues to build out the base, then starts to tighten up near the right side of the base and starts to head up into resistance, and then begins to finally break out. This, I think this is better on the weekly. This was a very very weird chart. I have to admit, guys, you're probably never gonna see anything like this. This is a one of one chart. And then it finally broke out of that 60 level above resistance as you can consolidate it here. This is that phase that I talk about where you want to be aggressive. It's right here. Also looks like a cup and handle, yeah. If you guys know what a cup and handle is, it's just like this, and then you see the handle parts up here, and then you break out. We also got Baidu, just off the top of my head. This one I still have my analysis. Um, what's crazy is I wrote this down. You see this consolidation back into moving averages for opportunity number two, back here. So this was before this move of 35%. Wow. This is actually still my record trade, lifetime record trade. Silver might top it, depending on how we open up tomorrow. I think we are gapping up though in the future session. Yeah, we are, but I think not much off of where SLV closed though. But I don't know, we'll see. But yeah, Baidu, one of the cleanest bases that I've seen. So we got those three. I want to say Mooch are the my favorites. The thing about JD, by the way, this trade here, I mentioned it not because I do think it's an accumulation right now. Right, let me just say that I do think we are in accumulation. But the example that I was mentioning was the lower lows being bid up, right? And you can see that right here. Hold on, where do you go? And this here. You see kind of how these lows, every time a new low was made, volume started to pick up, and sellers made no progress until a final shakeout here. That set up a very, very nice opportunity to go long. And I caught this piece here on this shakeout. And then this was my initial ad on this day. So I was down initially, but this was just a starter. And then took the rest of my ads here on this day and some more on this day. And then that led to my average entry was probably, let's just say, around 31 or so. Led to a 15% move, which was a very nice win. And this was another example of me talking about trying to position myself before the herd. If you guys saw me trade this live, I think I did trade it here on the, not here, sorry, in the free server. I was talking about this way earlier from the 27th, where I thought that this was in potentially starting to build out some sort of accumulation. And then no one was talking about it at that time. People started to talk about it when it's set up here. If you're on Twitter at that time, you'll see a lot of gurus and a lot of your favorite trading guys that you probably follow talk about it up here, and that just failed. So I like to position myself in before the masses. Sometimes I like to add on something that looks like this, but in this case I was already positioned very, very nicely up the lows and had no reason to do that. Yeah, silver was a parabolic short today. I did trade it. Don't be impressed of me catching it though, because I did take multiple losses on this on the run up. I'll admit that. I'll be transparent, as I always am. If someone told you that they avoided every single choppy session from back here and just caught the exact top, it would be hard for me to believe them, because this did set up multiple opportunities before that I personally did lose on. This was my fifth attempt. Won on the first, and then lost three, and then won today. And my entry wasn't the best either. But when something this crazy happens, what can happen is put premiums actually gain value even with price moving higher, and that's what happened. So my average entry on the underlying was probably right around 102. And as price made a 4.7% move against me, my premiums were actually up about 15%. And then we finally got that big snapback. And I still am in half of my position swung into tomorrow. Yeah, it definitely is the craziest, probably, premium move that I've seen personally. It's happened to me before when trading a gold top as well. On, I don't remember which exact top that I caught, but one of them. But yeah, that can happen when charts really get super, super crazy. So I kind of got lucky with this one, but the setup was there. But yeah, you guys have any more questions? Oh, is Marvel in distribution? Sorry, I didn't see that. Let's take a look. Um, Potentially, yeah, maybe. It's kind of a messy chart though. Like this, I don't like charts that look like this. But this could be some sort of failed breakout for sure. This is a lower high. Wow, this is actually a nice setup. Yeah, I actually like this. It is a bit choppy. I think it's fair to say that. Certainly not the cleanest mover, but I do think that this could be setting up for a nice move. Yeah, especially with the SMH. I do think the SMH is also in distribution, and we could be in some sort of failed breakout up here, but we still haven't gotten any signs of any true kind of sell bar off the high, so I'm patiently waiting on that. When I was answering the same questions for market, I realized how Tesla had an even base top to bottom, and Nvidia is top heavy. What do you mean by an even base top to bottom? Tesla is definitely a very nice mover. Set up nice base here, and then a big breakout, and then a nice undercut here, and then a nice overshoot here. Could be in distribution. I honestly don't know. I didn't see the liquidation that I wanted up the highs. I didn't really see any sort of bars that looked like this or action that looks like this. More so, what I wanted to see, especially if we could have overshoot that 500 spot, which we're so close to doing, but we just didn't get that. But yeah, we could definitely be in distribution because this did also sweep all-time highs technically. Yeah, I just wanted that 500 spot to be overshooted. But yeah, earnings is gonna basically determine where this goes. So all eyes should be on that. I'm honestly surprised by this strength on tech. Certainly did not expect it. Yeah, I could see Tesla to 380. I could see even lower to retest this base here. A flat open and puts can go crazy on a Ivy crush on earnings. Avgo, I think, is in distribution. I actually caught a nice sell on this. It was on this day. I did it live in the free Discord. Price sold about 4% on one day, which was super, super nice. And you just wait. I would wait for some sort of consolidation because I don't want to go short down here personally because this technically did kind of, or is attempting to sweep into the gap. So I feel like an entry down here is extended. But I mean, if we can just kind of pop slightly higher and then begin to consolidate and set up some sort of kind of trend line, right? And price just kind of tightens up here. Does something like that. Maybe yeah, I could see that. With earnings being the failed breakout. I still have my eyes on the video. This is what I currently no position though, but this is what I'm looking for. I want to see price lose the daily moving averages and base under 185, and I'll be looking to get aggressive on this. Yeah, Avgo is in the bull gap. It swept that bull gap actually. Yeah, I just don't think it's tight enough. I think the short setup was valid last week. You had this opportunity to go short, which gave you a 1 day breakdown. And then you had this. Actually, this one was kind of hard because I'm not shorting this day, or at least not with size. And then on a gap down of 2%, don't like getting aggressive on that either. So it's kind of hard to execute on this, but it was a focus of mine. It's kind of unfortunate that to move. So 10%. Certainly a nice move. But yeah, I want to see in the video. This is my chart, and I will catch this move. Just can't short it here because this is not ready for speed. Remember, guys, the speed topic I was talking about. This is a good example. This is a good chart that I think will resolve lower, but price is just not ready yet for a momentum move lower. So instead, I'm watching for this to occur. And yeah, FOMC is on the way, so I'm waiting for post FOMC to get some ads. Ideally, we sell off right into that, and then FOMC gives us some sort of intraday pop, and then the conference is where we look to catch the initial like lower, something like that. But yeah, waiting post FOMC. Maybe next week as well. I don't know. We'll see. Just needs to consolidate. I can't just be shorting with this off the highs. I mean, I could attempt it, right? But it could also just chop around here. High chance it does that. So I'd much rather wait for this kind of 183 level to be lost. Also, guys, is anyone in here familiar with PCs? Because I'm thinking about building a PC, but I have no idea what to do. I have zero experience with PCs. I just have a Mac Mini. So if you do have any experience, please let me know. I would definitely appreciate some help. I don't really game. I mean sometimes I do, but that's on PS. I don't game on PC. Yeah, please, if you have any website, please do share. I'd appreciate that a lot. But yeah, I think I'm gonna end the stream here, guys. Great talking to you guys. Definitely nice to see more people join in. I think today was a very nice session. I certainly enjoyed teaching it, and we'll be back at it again tomorrow. See you guys. Have a great rest of your, what day is it today? Monday. Bye, everyone. Thank you, guys. Bye.